With all the stories in the news lately about the Biden administration's attempts to address the student loan crisis, many existing solutions are being overlooked. So, in this video, I wanted to talk about what those solutions are and how they can help you if you're struggling with repayment of federal student loans. The three main programs I wanted to talk about today are how you can get out of default quickly, how you can get an affordable repayment plan that tracks with your income, and how you might be able to shorten your repayment terms significantly. First, I wanted to talk about how you can get out of default. At the beginning of last year, the Fresh Start program implemented to help borrowers get out of default without having to go through the standard 9 to 10 month default rehabilitation program. Fresh Start applies to defaulted direct loans, defaulted FFEL loans, and defaulted Perkins loans that were taken back from the school by the Department of Education. Now, Perkins loans are administered and collected by the school you attended. For this reason, they are not held by the Department of Education. Therefore, they must not only be loans that are defaulted, but loans that the school surrendered back to the Department of Education for further action. For this reason, Fresh Start does not apply to defaulted Perkins loans still held by the school, defaulted health education assistant loan programs, direct loans that defaulted after December 31, 2022, FFEL loans that defaulted after December 31, 2022, and defaulted student loans in litigation. Now, this last one is rare and involves situations in which the Department of Education sought to collect the debt by having a U.S. attorney sue you. If your loan defaulted during the pandemic pause, it will have been taken out of default automatically. Last fall, the Department of Education began reporting defaulted loans as current rather than collections to credit reporting agencies. If this happened to you, if you haven't already, you need to get into an affordable repayment plan, possibly income driven. You don't have forever to get out of default using Fresh Start, too. The program only lasts through September of this year. How you avail yourself of the Fresh Start program depends upon the type of loan you have. If you have FFEL loans, which would have been taken out prior to July 1, 2010, you have to contact the guarantee agency for the loan. Information on each agency is provided by the Department of Education on its website, and I'll provide this link in the description. If you don't know who the guarantee agency is, you can call this number, which I'll also leave in the description. Now, if you have direct loans, you have three options. You can apply online, by telephone, or by mail. If you apply by phone, be sure to have your income from the most recent tax return, and you should really use your 2023 return. When you're asked why you're calling, you'll need to indicate that you're calling about the Fresh Start program. You will also be given an opportunity to get into an income-driven repayment plan. The snail mail option is one that I don't recommend because it's slower and a little bit more involved. You need to send it to this address with a letter including your full name, social security number, and date of birth, and saying, I would like to use Fresh Start to bring my loans back into good standing. So that's how you get out of default. But how do you get into an affordable repayment plan? Fortunately, the Department of Education has several repayment options that track with your income. Let's take a look at what they are. Now, there are programs for both student borrowers and parent borrowers, but unfortunately, there's only one option for parent borrowers. For student borrowers, there's the income-based repayment plan, the pay-as-you-earn plan, the saving of a valuable education plan, and for parents, there's just the income contingent repayment plan. Now, first, there's the income-based repayment. Now, this program looks to see whether your regular monthly income exceeds 15% of your discretionary income, or 10% if you started borrowing after July 1 of 2014. Under this plan, your payment is never higher than your standard repayment plan amount. So if at some point you can afford the standard payment, it will no longer be calculated based on a percentage of discretionary income, which could be higher. The payment period is 25 years, but shortened to 20 years if you borrowed after July 1 of 2014. Unfortunately, this is the only option for FFEL loan holders. And in case you were wondering, discretionary income is based on 225% of the federal poverty level. Next, there's pay as you earn. Now, this caps payment at 10% of discretionary income, with the payment never being higher than a 10-year standard repayment amount, and goes for 20 years. Now, this is an Obama-era payment plan that has a fairly narrow pool of eligible borrowers. You must be a new borrower as of October 1, 2007, and receive a disbursement of a direct loan on or after October 1, 2011. And then there's the SAVE plan. This caps your payment at 10% of discretionary income, which will lower to 5% as of July 1 of this year. Now, the downside of this repayment plan is that the payment can be higher than your standard repayment amount. So if at some point you can afford the regular payment, you may end up paying more than that under the plan. And the payment period is 20 years for undergraduate loans and 25 years for graduate loans. Finally, for parent borrowers, there's the income contingent repayment plan. This is 20% of your discretionary income, or what you would pay on a repayment plan, with a fixed payment over the course of 12 years, adjusted according to your income. As with the SAVE program, your payment can be higher than the 10-year standard repayment amount, and it goes on for 25 years. Unfortunately, it's only available for direct loans. So if your Parent Plus loans were taken out prior to July 1, 2010 under the FFEL program, you would need to consolidate those loans to direct loans to use this repayment plan. Now, if you want to find out what payment plan is best for you, you can use the Department of Education's loan simulator, and I'll leave this link in the description below. Now, this particular Department of Education program is one that has been talked about very little in the news, if at all, and can be incredibly powerful and effective in shortening the repayment term of your loans. I talked about 20 or 25-year repayment plans that are income driven. This can be a long time, but you might be able to shorten this. Now, this program is particularly effective for borrowers with FFEL or direct loans who have loans that fell due over 10 years ago, have been in repayment, even if not in an income-driven plan, have been in forbearances, or have been in deferments prior to 2013. And the great thing about this program is that all the months that the loans have been in repayment, forbearance, or deferment count towards that 20 to 25-year income-driven repayment plan. Now, your loan doesn't have to be that old to qualify. But for example, let's say a borrower had their loans fall due in May of 2007 when they graduated, never got into an income-driven repayment plan, spent time in forbearances when they couldn't afford payments, and had no months in default or bankruptcy where there wasn't a payment or forbearance or deferment. In that event, those 15 years and 4 months since the loan fell due would then count towards an income-driven plan. So they would have less than 5 years remaining in a 20-year plan or less than 10 years in a 25-year plan. But like anything else, there's a catch. All the federal loans must be direct, not FFEL. So if you have FFEL or Perkins loans, you would need to apply for a loan consolidation by April 30 of this year to benefit from the recount. You don't need to do anything else. The recount will be done automatically on all direct loans and is expected to be completed by July 1 of this year. Now, it's important to bear in mind that if you aren't currently in an income-driven repayment plan and the recount doesn't pay off the balance, you'll need to apply for a repayment plan. If you're in an income-driven repayment plan when the pandemic started and that payment hasn't already recalculated for your current situation, the payment amount will resume at the amount it was in March of 2020. But if your income situation has changed for the worse since then, you would need to request a recalculation. So those are the highlights of what programs are available to help you with your federal student loans. If all of this is a little overwhelming and you're not sure what you need to do, I can help. All you have to do is go to studentaid.gov and download your loan records. Then go to my analysis portal and I'll upload it. And I'll leave a link to that in the description. And then after you uploaded it to my portal, I'll then review it to see if I can help. If I can, we can schedule a consultation and analysis session. So good luck, and I hope you're able to get your federal student loans back on track.